Welcome to the podcast from Morningstar UK, the leading provider of independent investment research. This week, we're going to take a look at passive investing. When Jack Bogle, founder of Vanguard Asset Management, launched the first passive fund in 1975, he was called un-American. The financial industry was so against his plan to revolutionise the way that we invest, a campaign was mounted insinuating Bogle was unpatriotic and a fool. Fast forward 3 decades and new money invested in passive funds is growing at a much faster pace than actively managed funds. In the US last month, investors pulled $18 billion out of active funds, but invested $49 billion into passive funds. The story is similar on this side of the pond. The fastest growing part of the market in the UK is passively managed funds, and in particular, those which are smart or strategic and offer investors access to a certain slice of the market. But what exactly is a passive fund? And are they better than actively managed funds in all circumstances? When should you opt for a passive solution, and what role should an ETF play in your portfolio? Let's first go to Dan Kemp, Chief Investment Officer for Morningstar Investment Management, who explains the benefits of using passive funds in an investment portfolio.
Many people are surprised when they discover that Morningstar Investment Management uses passive funds in our portfolios, as Morningstar is more typically associated with active fund research, but we think they play a really important role in portfolio construction. First, they're a great way of harnessing valuation-driven opportunities at a sector, market, or even asset class level. Active fund managers often stray from the precise assets that you're trying to access, and you don't always get the opportunity you want. But with passive funds, you normally know what you're buying. Second, they are a great way of reducing costs. As Burton Malkiel said, you can't control what markets do, but you can control the costs you pay. Costs act like a tax on investment, so the lower the costs you pay, the better the returns you're likely to receive. But it's important to remember that not all passive funds are equal. Research is as important in the passive arena as it is with active funds, and we work as closely with the passive fund research team here at Morningstar as we do with their active colleagues. But possibly the biggest challenge when using passive funds is the shift in responsibility. When you're using an active fund, the manager not only needs a good investment process, but also needs to be able to control the behavioural biases that we all suffer. But when you're using passive funds, that responsibility shifts to you. Unless you're able to control your own behavioural biases, then passive funds may do more harm than good.
Up next, Christine Benz from Morningstar speaks with Vanguard founder Jack Bogle himself about how investors need to look at how unnecessary fund costs are eating away at their investment gains.
Hi, I'm Christine Benz from Morningstar.com. I recently had the opportunity to sit down with Vanguard founder Jack Bogle. We discussed his return forecasts for the major asset classes. Jack, thank you so much for being here.
Always good to be an annual occasion,
It's
Christine.
an annual privilege for me. Let's talk about your return expectations for stocks and bonds, starting with equities. I think you have a really intuitive formula for forecasting equity market returns over the next decade. Let's talk about how you get there and where you arrive.
Sure, it's very simple, easy to explain. Everybody knows this, but I don't think anybody else has ever put it down the way I have. I've been using it for 25 years, and it works. It's worked beautifully for the full period. Every once in a while, a decade is off by a good bit, and then it's made up in the next decade. But it places stock returns into 2 categories. Investment return. That's what you're earning on the stock. That's your dividend yield when you buy in a crucial number, and the earnings yield, the earnings growth that subsequently follows. And the other is speculative return, which is change in valuation of stocks generally, easily measured by the change in the price-earnings multiple. And for example, which happened in the 80s and again in the 90s, the price-earnings multiple roughly doubled twice, from 10 to 20, and that doubling is a 7% per year increase in valuation. And did the same thing in the 90s. That's a 7%.
Sent us into bubble territory at that point.
Yeah, got us into bubble territory. And so in those 2 decades, the markets had returns of about 17% a year. But if you had even the most general idea that having gone from 10 to 20 to 40 times earnings, the next decade would have to go to 80 times earnings to continue those returns. You'd realize that it was just a lot of air. That's what valuations can get to in bubbles. So putting all that together, we're looking ahead. First, we'll deal with stocks here first. We're looking ahead to some challenges compared to what we've had in the past. So today, the dividend yield is 2%. The previous 50-year average or so is like 3.5% dividend yield, and that's a dead weight loss of 1.5% in return. You can make it up in other places, but you can't make it up there. And the growth in earnings over the past 50 years has been about 6.5%. I don't think it's going to be that high, so I use 5% for earnings growth, and that gives me a 7%, roughly a 7% investment return on stocks. Now, here's the tough. Those are pretty anchored, right? Because we know the dividend yield, and earnings growth is such that we could have a 2% earnings growth, and we could have a 10, but we're highly unlikely to have 0, and we're highly unlikely to have 20. So there's a sort of a centrality to earnings growth, and so the problem is in the valuations. And today the stock market is selling at about 23 times earnings, and the long-term norm is 17 times earnings, a little bit below that actually. And that would cost you 3% if the market ended this decade. I don't do this for anything but decades. It doesn't work at all year by year. But that would mean you'd lose 3% of that return.
So down to 4%.
Down to 4%. And
not inflation adjusted, so add in inflation.
No, well, we'll get to the deductions in a minute.
The number's getting skinnier.
4%, or it could be around 5%. I don't mean to be too precise, but say in the range of 4 to 5%. And the bond returns, the Treasury is 10-year Treasury, which is the basic benchmark, is at 1.6%. And I think very few people are going to be satisfied with that. So by going a little longer and a little less in governments and federal securities, U.S. government securities, you could probably get a 2.5% return without an awful lot of problems. So you've got that 4% for stocks, 2.5% for bonds. And I'll use a 50-50 portfolio because it makes the math easier. That's around 3%. Am I doing that right? Yeah, around 3% for a balanced portfolio. Now, that's the good news, if you will. The bad news is these are market returns, and nobody captures the total market return. Even a good index fund, S&P 500 say, or total bond market, will capture the total return of the market by the market return itself minus 0.05%. That's probably going to be as well as you can do. But just for the fun of it, let's first take inflation out.
Right.
And I think 1.5% to 2% is a reasonable way to look at inflation. We're not even running that high today. So you take that off that, what did we decide, 3, and then you're 1.5%, and that's not a very good, that's not something that's going to make you very happy. Right. But the reality, my view of reality may be wrong, but the reality is we should be expecting much lower market returns. Now, when you take inflation out and get to real returns, then we deal with the fact that nobody gets the market's return. They have costs. And the typical mutual fund, if you look at its expense ratio and add into its transaction costs, its portfolio turnover cost, is 2% a year. We're now into negative real returns. And so it suggests, he said commercially, that people should be looking to index funds.
Very low cost products.
0.05%. And and then you take out of that, there's more to come, unfortunately, and that is in the mutual fund field, particularly the actively managed mutual fund fields. You pay unnecessary taxes, that are capital gains taxes, that index funds are not subject to in a taxable account, not so in a tax-free account, fair enough. And then you have behavior problems, investor behavior, which the record clearly shows, Morningstar clearly shows, costs you 1.5% a year over the investor return, lags the mutual fund's return by 1.5%. And let's put the extra taxes at 0.5%. That's another 2%. So the message is so obvious. We have managed funds that have much lower expenses than others and much lower turnover costs. But, I'm not condemning all managed funds, but I am saying an investor that doesn't look at the difference between the stock and bond market return, nominal, and the stock and bond market return, real, and then look at cost, and then look at the unnecessary cost that comes with active management, they're making a big mistake, a very big mistake and a bad mistake. Because once you compound these kinds of numbers for an investment lifetime, it's dramatic. I mean, you probably get 10%. If you're positive, you might get 10% of what you would get by just investing at those low rates in the right fashion.
So what exactly is the difference between an ETF and a tracker fund? Morningstar passive fund analyst Kenneth Lamont is up next to explain.
Well, investors traditionally invest in passive funds for their low cost and for the transparency associated with these funds. The two major options that investors in the UK have are traditional mutual fund, index funds, and exchange-traded funds. The primary difference between these two products is that mutual funds are priced once a day and have a traditional, as I say, mutual fund structure, whereas ETFs are priced throughout the day and traded like a stock on exchanges. The second major difference between the two is that ETFs, certainly in Europe, have a far larger breadth of exposure that they offer. For example, you may be able to buy an ETF which gives you sole access to one country like Vietnam, whereas this exposure is not available with index funds. Also, ETFs are more versatile in the sense that there's a far higher percentage of these funds which are synthetically replicated as opposed to physically replicated.
ETF providers are very transparent when it comes to replication and will explicitly disclose whether an ETF is physical or synthetic in the kit and prospectus. But if you're still confused, our very own passive fund expert and senior analyst Jose Garcia Zarate is here to clear things up about the differences between physical and synthetically backed ETFs.
Exchange-traded funds are index tracking vehicles. This means that they replicate the performance of a benchmark. European ETFs can employ physical or synthetic replication methodologies. A physical ETF replicates the performance of the index by physically holding all or part of the index constituents. Meanwhile, a synthetic ETF replicates the performance of the index via a swap agreement. This normally means that the synthetic ETFs hold a basket of securities which may not be related to the index they track. And what they do is exchange the performance of this basket for the performance of the index via a swap contract with a counterparty, which in most cases is an investment bank. Some investors may not care about the way the ETF goes about replicating the performance of the index. However, others may have a particular preference. The good thing is that ETF providers are very transparent when it comes to replication and will explicitly disclose whether an ETF is physical or synthetic in the kit and prospectus.
Did you know you can minimize the volatility of emerging markets through ETFs? Or focus on income? Or gain access to the whole market for a fee of just 0.2%? Senior editor for Morningstar Emma Wall and passive fund analyst Monica Dutt are up next to discuss different ways to profit from an emerging market rally.
Hi, Monica.
Hi, Emma.
So emerging markets finally seem to have resurged this year, both in terms of performance and indeed inflows, haven't they?
That's right. A lot of investor sentiment is coming back into EM after many years of lackluster returns. That's partly because of the strong US dollar and a softer stance on interest rates.
And what we're going to talk about today is ETFs, because I think a lot of people are unaware of the variety of ETFs out there in order to gain exposure to this asset class. They know that active funds have many different proceeds, but for them, emerging markets may only come in that market cap weighted sphere. Perhaps if we start with that traditional type of ETF, and then you can explain a couple of other ways people can get exposure to this asset class.
Sure. So the traditional way is the market cap weighted benchmark, and that's usually the MSCI Emerging Markets Index. So one ETF which we like is the Amundi MSCI Emerging Markets ETF.
And that's been very popular, hasn't it? It's quite a big ETF.
That's partly because it's cheap. It's only 20 basis points, and that gives it a head start. But there are many drawbacks to a market cap weighted approach.
Such as?
For example, South Korea, China, and Taiwan make up more than half of the total portfolio, and China alone comprises about 27%.
And that's going to rise, isn't it? Because there's a conversation at the moment with MSCI, including different types of China shares within its universe, which could potentially make this MSCI Emerging Market Index actually a sort of 60% China index.
Yeah, about 40%.
And so for people who want better diversification or want an ETF based on something other than market cap, what options are there?
So away from market cap, we also have the Ishares MSCI Minimum Volatility ETF, which is 40 basis points. And a risk-reducing strategy for EM makes sense because the nature of EM is very volatile, as well as the currencies.
And it does actually put a lot of people off investing in emerging markets, that volatility, the fact that underlying factors such as commodities or politics can really drag the market around. So would this be a strategic beta ETF?
Exactly. It's a risk-reducing strategy, so it creates a lower volatility portfolio.
But because of that, it does have that slightly higher fee.
Exactly.
And what's the third ETF you'd like to highlight today?
The third ETF is the SPDR S&P Emerging Markets Dividend ETF, because many investors now are deprived of income. So this is a portfolio that focuses on the highest dividend payers within EM countries.
Because in developed markets, both in equities and in bonds, yields have really been depressed because of, we've seen equity rallies in developed markets and we've seen interest rates come down. So looking to emerging markets for alternative source of income makes sense. But there has been a bit of a patchy performance record for these types of ETFs, haven't there?
Exactly. They have underperformed in total return terms compared to their market cap weighted funds. But that's mostly been because of sector and country biases. They tend to favor countries that pay out higher dividends, like Taiwan or Brazil or Russia even. And as you know, these countries have been hurt by fluctuations in currencies.
And I suppose this helps to highlight the fact that, just like with active fund investment, you can choose a number of different ETFs and blend them together in order to get the best diversified access to emerging markets.
Exactly.
So they are complementary to one another. Mm-hmm. Monica, thank you very much.
Thank you.
Let's now go back to Christine Benz and Jack Bogle, who discussed the issue of risk and why investors should not be tempted to take on too much of it in retirement.
What would your counsel be to investors? It seems like for investors with very long time horizons, it shouldn't be a big deal. They make it through sort of a tough next decade, but maybe better returns after that. But how about people who are retiring into this market environment? That's a fairly meager return expectation. What should retirees be thinking
first,
about?
Never underrate the possibilities that I'm wrong.
Okay.
But having said that, I think an investor is wiser to plan a lower return rather than plan a higher return.
Right.
Because if you've got much more money when you retire than you expect, well, there are worse things that can happen to you in this life than
right.
that. But if you've got much less, there may not be many worse things. You've got to lean on your children or something like that. But I'd say a couple of things. One, stick with the market return, whether it's the bond market return. Don't try and do better. Don't go out and buy commodities or gold. Don't buy hyped up real estate master limited partnerships. Don't buy commodities. I mean, the list of don'ts could go on forever. Just stick with the market. Don't try and do any better, because once you get out, that means owning differently than the different portfolio in the market. The chances are just about the same, and you'll do worse than better in a low return environment. I think that's bad. So you're consigned to a low yield, although I should quickly add that yields are not as bad as people think, because real yields are not that far from their historical norms, because we had like 4% inflation in the last 50 years, and now we're looking at maybe 1 or 1.5%. So real yields are down. Real yields today are probably negative for the Treasury bill, and they were probably positive by about 1%, not Treasury bill, Treasury 10-year. And for the last 50 years, they've probably been about positive 1%. That's not a huge difference. So it's difficult. So here the options are stick with the market return and draw down some capital. Do not reach for yield.
Well, that's been a big challenge with retirees. Many retirees have been gravitating toward higher yielding sectors, whether high yield bonds or high income stocks.
And those high yield bond portfolios, I'd warn any investor, the difference between high yield bond portfolio A and high yield bond portfolio B can be enormous. And we like to think we run the highest high yield bond portfolio around, which we can afford to do because of you guessed it. We can provide the same yield because of our cost, which for our high yield bond fund is probably 30 basis points or something. Very low, and the industry is probably 1.5. So we can take a 1.5% lower yield and therefore reach for less yield. So be very careful about the selection I would give investors. And if you want to do that, it's not awful, but if you want to do it only in limited terms, should your bond portfolio be a third in high yield bonds, for example, I would say that's too much. These are just judgments, personal judgments, flawed. But be careful about going deeply into any other sector rather than seasoning your portfolio in it. So you can withdraw a little capital, and if the market does a little better as time goes on, you can maybe even increase that withdrawal. So that's what you, I think, really have to do. And then for younger people, you have to save more. And it's not easy, I know that. You got all these conflicting things. You're trying to build up a college account. You're trying to do all these. The demands are great and enormous, and a family of modest means simply can't do it all. So it's save more if you possibly can. And as time goes on, I'm a great one for saying stay the course, to say the least, but change your course a little bit if it turns out that in the next 5 or 6 years we get very good returns, and those returns that will bring us down to what I've talked about don't come a little further off in time. You might want to withdraw a little or something. I'm not for market timing, but I am, you can't do a family financial planning without thinking about, some integration of the income that's actually being yielded. And those, by the way, are the returns on the funds that we talked about, not the income yields. Stocks yield 2%. You can get a 2.5% portfolio of bonds. So in a balanced portfolio, you're getting 2.25% a year before cost. Here you're going to be lucky to get 1%. So be careful about cost, always. It's just so obvious. Most obvious, the money market fund, and which people are leaving now because of the gates that have been put up there, the possible gates that can go up. It'll be interesting to see how that comes out. But I always, an editorial comment, thought it was better that money market funds shouldn't be used in an investment account. If you need the money, short-term savings accounts, fine. But you should be using short-term bond funds. And
within your investment portfolio.
In your investment portfolio, yeah. Short and intermediate is what I would do. I don't do long, because I just think I'm reading people's minds now, but most people can't deal with the volatility.
The volatility isn't very bond-like, is it?
Yeah, exactly. If you just don't look, you'll be okay.
Right.
Don't peek.
Right.
ETFs have grown in popularity as investors cotton on to the impact of cost on real returns, and now passive funds can be used to build a diversified and profitable portfolio. Senior Editor Emma Wall discusses with our final guest Ursula Marchioni, Chief Strategist for Ishares, on how to get the most out of ETFs when using them in your portfolio.
Hi Ursula.
Hi Emma.
So we're here today to talk about how people use ETFs in their portfolios and how they can best use ETFs in their portfolios. I thought we'd start by going back a bit and seeing how people have used ETFs in the past and how that's changed in recent years as passive investing has gained in popularity.
Absolutely. So my first answer would be that there is no one use for ETFs investors' portfolios. So over the years, we have seen the classic core satellite approach, where index investing, also known as passive, has been a very popular choice for core strategic long-term holdings, which were then coupled with alpha strategies, which tend to be allocated to the satellite, and that's where investors tend to take bets in terms of the good managers that they believe will generate extra returns. That is certainly one aspect of it, but over the years we've seen appearance of other solutions, for example the reverse core satellite, where active strategies have been put in the core and used as strategic long-term holdings, and ETFs and index funds have been used as a liquidity sleeve or a liquidity tool to manage inflows and outflows without having to disturb the active manager's strategy with inflows or outflows. In general, I would say one theme that runs across both solutions is the fact that over the last few years we have seen the breadth of solutions, the strategies that you can actually access through these vehicles really grow exponentially. If you think about the rise of fixed income ETFs, the industry in Europe has now exceeded 150 billion in size. Ishares is over 100 billion of that. So it's been a massive journey for investors. And that's just one of the many examples. Smart beta or strategic beta is certainly another. So I think we are at the very exciting time in terms of how ETFs can now play a role in portfolios.
I think what you said there is very interesting and certainly true of our readers and investors sort of in the UK. And they may first come to passive strategies, to ETFs, with the idea of investing in a very liquid equity market, such as the S&P 500 or the FTSE 100. But then actually you see that growth and move into bonds, to commodities, gold obviously being a firm favourite this year. And indeed these alternative non-market cap weighted strategies, strategic beta or smart beta. Should we expect this trend to continue and people to be increasingly diversified in their passive investing?
Absolutely. I'm a firm believer that that is the case. I think the trend that we have seen will continue for a variety of reasons. One is the fact that index strategies in general deliver diversification and cost-efficient access to the underlying. So as the industry evolves, investors will certainly embrace the opportunity to access new parts of the financial markets with these two great benefits. A third benefit that I would definitely mention is the fact that index investing has proven to be very flexible over the years. To your point, absolutely. The first index was born a couple of centuries ago to access the US large cap sector, railways, companies in particular. And if you think about the journey since then across all the exposures and the innovation that you've mentioned, it's been great. And it will continue because, again, these big benefits that investors can enjoy and harness through index investing are here to stay and will continue to resonate going forward.
And is there anything that investors should consider before investing in ETFs that they may not have done before in the past because they've only been active strategy investors?
Yes, so I would mention two main things. The first one might be slightly surprising, but at BlackRock we are firm believers that due diligence is needed for index investing as well. So not all managers are created equal, not all products were created equal. And there is a bit of a myth in the industry that indexing is commoditized and ultimately you're just replicating a benchmark. But in fact, there are a lot of active choices that the portfolio manager has to make in terms of when the index rebalance or when sampling might be needed. So I would definitely say, number one, perform due diligence and think about the manager's track record in terms of his or her ability to deliver a result that is actually close to what the benchmark stands for. Number two, I would recommend to go beyond a simple TER-based approach. TER is certainly an important point. We live in a lower for longer environment, so everybody is much more cost-focused. Everybody needs and wants to be efficient, and that should be embraced, but should be I would say applied in an holistic manner. There are certainly costs attached to the holding period of an instrument. So the TER is one of those, but it should be considered together with potential securities lending revenues or tax rebates or withholding tax effects that might come through. And then equally, the cost of accessing and exiting from the instrument should be considered. So from an ETF perspective, the bid-offer spread. So I would say look at the manager, look at the track record, number one, and two, look at how closely you get to the index, thinking about a holistic approach to cost through TR and other holding related effects, but also the trading aspect.
Ursula, thank you very much.
Thank you, Emma.
And that's the end of this edition. We hope you enjoyed this programme. From everyone here at Morningstar UK, thanks for listening.